What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances. Welcome back to the series on home ownership. So in this segment today, me and Thomas are going to be talking through the ongoing costs. So in previous segments, we've talked about the costs when you're buying a home, things to be thinking about. We've talked about mortgages. Today, we really want to talk about what are the ongoing costs, but we really want to talk about it in the framing of how do Thomas and I think about budgeting for ourselves for these ongoing costs? And then also, how do we talk to clients about it?
All right, let's get right into it. So I think the first one that everybody knows is, principal and interest, right? Hey, I buy a $750,000 house. I'm going to put 20% down. Current interest rate 7.21 or 7.2%. That means I'm going to have a principal and interest payment of $4,100. And I think a lot of times people hear this and they're like, great, $4,100. I think I can handle that. Let's move on from there. But obviously that's just part one. I'm going to kind of rifle through these, to be honest. So number two is PMI. So PMI is just private mortgage insurance. It's basically this added on insurance cost that they put on you for not putting 20% down. Obviously, the example I just used, I said 20% down. But if you don't, companies are just basically like, hey, you're a little bit less credible of a lender. Let's end up adding this little cost to you. It can be anywhere from statistically, it says 0.2 to 2%. I don't think I've ever seen it above 1. I think typically I see it around 0.5%, but I would say most times you're somewhere between 0.2 to 1%. And that's just an added cost that you end up paying monthly. Next one's property taxes. So if I go back to that example, and I'm just going to use where I live, Carmel, Indiana, is, the example, if you have a $750,000 home, you're going to have $4,100 of principal and interest, and then property taxes are going to be $544 a month. I think this one's really important because I think a lot of times people, again, they only do that beginning part of principal and interest, and property taxes are so different from place to place. So my sister, she lives in a Chicago suburb, and for her, this would be $1,450 a month of property taxes, about $900 difference a month. So if you didn't go through this, assume it, and actually look up the numbers, you could end up being very off of just in general what you can afford. Next one is homeowners insurance. So again, I think we've talked about this in the series. Homeowners insurance definitely ranges from place to place. If you're in California, you're not going to be able to buy a house for $750,000 anyways. But in general, if you were in California, property taxes homeowners insurance might be anywhere from $300 to $700 a month versus, here in Indiana, it's probably going to be about $2,400 a month. And again, that's just really because of risks and how often people are going to use homeowners insurance. I'm curious for you, Jacob, what's your homeowners insurance a month?
I think we pay $5,000 for the year for our homeowners right now. But that's gone up significantly. When we first bought the house, we were paying less than $3,000 a year. And so you're thinking, it's almost doubled in 9 years.
Yeah. And I think that's important to note, right? Principal and interest is fixed unless you refinance. PMI is going to be fixed until you hit 20% and can get rid of it. Property taxes are going to be variable. They're going to change from time to time. A couple episodes ago, I was really talking about some of my clients local to me who are paying almost 250% more than they were a couple of years ago. But definitely something that you want to plan for. The next one, you go.
One other thing I want to mention on homeowners insurance, Thomas, I know both you and I help clients with property and casualty insurance, and homeowners is a big part of that. Homeowners insurance, guys, I can't urge this enough. Don't go out and try to find the cheapest homeowners insurance you can possibly get, because homeowners insurance is not just standard across the board. I have homeowners insurance, I check the box. You want to find the best value for the homeowners insurance that your property needs.
Yep.
So a couple things just to think about here is there's different homeowners policies out there. I'm not going to get into the detail of them today, but I think it's really important for you to understand the reason why you're getting homeowners insurance is in the event that the worst case scenarios happens. Lightning strikes your home and it burns down. I live in St. Louis. We have tornadoes. A tornado hits my house and it all goes away. Well, guess what? If my house goes away, my neighbor's house is probably going away, and the house down the street is probably going away. I'm going to tell you right now, whoever has the most money coming from their homeowner's policy to rebuild their home is getting their home rebuilt first. So I just say that because I think a lot of people shop only on price. Price does matter, but what matters more is the value you're getting for the price that you're paying.
Yeah, it's like price of an apples to apples policy, right? And so
100%.
that's a big one. So that's like the cost to rebuild. A lot of times, it doesn't have to be the cost of your home, because in general, like there's a price to land. So if yours is if yours is $1 million, you might not need $1 million. You might need like 800 or whatever that might be. But the other thing that I think people forget to think about is like liability protection. I've heard stories of somebody slipping and falling off a railing and dying. You have a kid's birthday party and a kid slips and cracks their head open, right? And as much as you might want to believe that nobody's ever going to be at your house that would sue you, that's not the world that we live in. And so if you don't have coverage, if you have $300,000 of coverage or $100,000 of coverage and you get sued for 500, that's coming out of your pocket. So you want to make sure that all of those key provisions are there. A lot of times you want to make sure that the cost of replacing your roof is included there. Those are, I guess, some of the main ones that I look at. If you have a basement, you want to make sure that, if it gets flooded, that you have coverage for that. Sometimes in the coast, you might want hurricane or flood coverage, depending on the cost. It is really expensive there, but all of those are really important things to think through and look through.
Yeah, 100%. I just think it's really important as we walk through these different costs, just to understand that like there are going to be costs that change over time. Homeowners insurance is probably the biggest one that has the most variability on it. It might not be the most expensive cost you have. It's not going to be as much as your principal and interest of your mortgage, but there are going to be variable costs in it. I know, Thomas, one of the things that we wanted to touch on was how do we budget in for some of these variable costs when we think about property or we think about principal and interest, we think about homeowners insurance, we think about maintenance costs that are going to come up along the way. Some of these things are going to stay more consistent, right? If our mortgage is $3,000 every single month, we know that's going to be consistently there. But some of these other aspects, like the homeowners insurance, is going to vary from time to time. In addition to that, some of these are going to be just big lump sum payments throughout the year that are going to cover us for the entire next year. So I'd love to hear your thoughts on not only the advice that you give clients with this, but how you think about it with your own finances.
I think it's a good one. I think it's part of the reason of having an emergency fund. I think the hope is like, as these costs are increasing, your income is increasing, hopefully faster, where it's not an issue. But let's say your income stayed flat and your costs went up. Like that might be a year that you have to scale back a little bit on investing. It might be a year you have to tap into your emergency fund for a few things. I think maybe if you want to ahead of time, you could be like, okay, what does my income trajectory look like in a realistic situation, right? Like don't be the person who, you work for the government and they 1 year gave 7%, but every year average 3%, and you bank on, I can afford it 3 years down the line. I'll be able to save again in 3 years because I got a 7% increase of income. But I think you do need to be realistic and say, hey, here's probably what my income looks like. Because I think, let's say you're a teacher, right? Teachers very, very steady on their income and where it's going to go. You don't want to buy a house that's going to be really tight now, right? Because that your income growth is not going to outpass that. If you're hey, I'm a lawyer, I'm an associate, after 3 years, 90% of people move up. Worst case, it's 4 years. You might be able to pick a little bit tighter of an amount. Or, hey, I'm in accounting, I'm going to pass my CPA. I know after my CPA, I move up $20,000. And then on average, they do 10% a year. Like when you know your income trajectory, it's a little bit easier to be okay with things being tight early on. But I think the other thing I help people think through is like, hey, you're newly married. You don't have any kids. Are you guys going to have one stay at home? What are you going to do? And a lot of times people go buy a house and they haven't really thought about those income changes that might be coming down the line. I even have a client I'm working on now who they were really thinking about buying a house, but their biggest goal is to start a business next year and it's going to be capital intensive. They have no idea where it's going to go. And increasing your monthly expenses by $5,000 a month going into starting a business probably isn't the best decision. You might want to see where the business goes first.
Yeah, what I always think about is just you want the flexibility, and to even take it to a more granular level. When I think about the expenses that I've had in my home, one of the biggest surprises I had when I first started owning a home was somewhat new to that I'm going to budget for some of these other expenses that come up. But I didn't quite realize that, oh man, like in June when my homeowners comes up, like I got to write the check for $3,000, $4,000, $5,000. Or in December, we didn't escrow any of our property taxes. Property taxes come around and it's $10,000. And you just need to make sure that you're aware of those things, because typically when we think about a monthly budget, if somebody says, well, what do you spend a month? You give them one number, right? I spend whatever, $10,000 a month. But the reality is you don't actually spend $10,000 on the button every single month. There's might be months where you spend 8 and there's months when you spend 12. And I just think from even a mental standpoint, just understanding what are those big months that are coming up that I know, hey, I need to make sure that I have a little bit more in my emergency fund to be covering the property taxes that are going to be coming out next month. Because I just always go back to like, I hate seeing clients get in a situation where they buy something for the enjoyment of their life and it ends up just owning them because that's all they can think about is the fact that they're spending all this money and they weren't prepared for it.
Yeah, I think you made a really good point there too. Like some people aren't escrowing property taxes, insurance, etc. And so like planning for those lumpy expenses, like go to Ally, go to any high yield savings account, just do it like you normally would. If it's cheaper to do it once a year in any, expenses that you're planning for, just carve that out monthly, save for it monthly. If you're somebody that, I have some clients who are like 50% of their comp is RSUs, 50% is, salary, or people who are like, hey, I pay my salary from the business, I have quarterly large distributions. You can plan from it from lumpy times where you're getting extra income. But regardless, you need to figure out how to systematically save. So when that comes about, the dollars are there, just like you would for taxes or anything else.
One other thing I'll say, and this is somewhat of an investment topic, but I think it flows in nicely to us talking about flexibility of this stuff. Thomas and I, you and I both talk a lot about tax planning. We both work with a lot of business owners, and business owners hate paying taxes. And one of the best ways to reduce your taxable income in a given year is contribute to retirement accounts. We've done episodes on the different retirement accounts that business owners should think about. But one thing to be thinking about is if you're incurring more expenses or you're expecting to incur more expenses in that given year, you're buying a home, right? Maybe contributing a little bit less to retirement accounts and maybe contributing a little bit more to your taxable portfolio, where you're going to have potential increased flexibility in taking that money in the earnings from it in the future to put towards some of these lumpy expenses that come in the future. And just a little thing there, we're just saying like, hey, what is the best way for me to still get the benefit that I want of increasing my net worth, but I'm also increasing my flexibility along the way. So I'm not in a position where, well, I made this huge contribution to my defined benefit plan and I really don't want to go back on it, but I also want the money to be able to pay these property taxes that I wasn't thinking about.
Yeah, I think really good point, especially when it's like retirement through work or DB plans. Like, I would still probably use my Roth IRA or backdoor Roth first, just knowing that you do have
100%
that capital. But some of those other ones where like you don't really have an option besides to borrow against your 401k, like that's definitely not a spot that you really want to be in. But I just want to hit on this last couple costs really quick. So HOA and condo fees, just making sure you plan for that. Like all of these, though, as I talk about them, like before you buy, you should have this all listed out and make sure that you can afford that monthly payment and not be too tight. So that's one. Another one is just house upkeep. I mean, you talked about this a couple episodes ago, how much you spent on lawn maintenance, et cetera, but it also is like, cleaners and window cleaners and some of these things that you go from renting to buying. You probably don't think about people having to clean the outside of your windows, but I promise you're going to end up wanting somebody to do that. Then we have increased utility costs. If you're going I went from a 1,400 square foot, one floor apartment to now a 2,500 square foot place. I just, estimated that I was going to have about double for that, but definitely something that you want to think about. And then really just maintenance. And again, we talked about this a couple episodes ago, but anywhere from probably 1% to 3% of the home value on average. It's not going to be that every year. It's going to be lumpy. But all of these things are things that you want to be able to plan for. And you want to make sure when all of those costs are added in, that's not 50% of your income or more, right? Like that's a lot. I really like the number of like, if it's under 30% of your gross income, even 25, 20%, you're going to be sitting really pretty. If it's 40 to 50%, you're probably going to have to give some things up, whether that's doing as much travel as you want, cars, other things with your family, maybe it could be saving for college, less for retirement. Like you're going to give something up if you're using that much on a house.
Yeah, 100%. I just think, again, it's just important to understand what these numbers are. And the other thing I would add for these lumpy expenses that might come up that you're not really sure what they are. Thomas, I know you like reverse budgeting. I do more of traditional budgeting, but I think whatever you're doing, however you're tracking it, do it in a way that it's going to have some sort of rollover capabilities, because you might have that expense in March and you might need to start planning for it in January, and you don't want to forget about it. So I use Monarch Money. It's a great tool that has a nice rollover feature to it where, let's say I'm budgeting $500 a month because I think there's going to be $500 a month in different home improvement that's going to come up. I know that in January there might be nothing, February there might be nothing, March there might be nothing, but then April there might be $1,800. Well, now I had budgeted $2,000 over the first 4 months of the year. It's just a good mental note for me. It's more of a personal thing. But again, I think part of spending money is feeling good about spending it. And one thing I've learned is by having some of those rollover capabilities where I can see, okay, no, I did budget for this, even though maybe I wasn't thinking about it in January, February, March. I did budget for it. So I feel comfortable being able to spend the money as opposed to feeling disappointed that, oh man, like I didn't even think about this, right? Thinking about it in advance has really helped me.
Yeah. No, I think that's incredibly well said. I think the last thing I know we got to go is to really talk quickly about what you should change once you buy this house. So I think the first one is right what you said. Like, I'm a big believer of reverse budgeting, but I think when you buy a house, you should actually go through some traditional budgeting the first few months. Maybe the first month isn't great when you're buying a whole bunch of furniture and other things, but once it's steady, let's get some data on what you're actually spending so we can figure out what that surplus is. Another one is that you're probably going to want to start some type of savings for maintenance, things that are coming up. I think you probably want to increase your emergency fund because now your costs are probably higher on a monthly basis. What used to be a 3-month emergency fund might be 1.5 or 2, or it was 6, might be 4. You want to fine tune that. Again, I would go back and review your insurances because in all reality, you might not have got the right homeowners policies. You might need umbrella insurance. You might need more life insurance that you have a higher amount of debt. You might need to raise your disability insurance because it might not be covering enough in expenses. I think all of those are, probably the most top of mind things that I think of, and I think the other one is I have a lot of clients who for the 1, 2, 3 years ahead of time, they are aggressively saving so hard for this house that they've been delaying investing in other things. That it might be hey, now let's go back to trying to max out retirement contributions and back to a Roths and go to a taxable account because we delayed it for a few years.
Yeah, you bring up a lot of great points there. I think even the life insurance point and the disability point is great. Most people don't think about that, but life insurance at very least, like I love to tell clients, like at very least, it should pay off any debts that you potentially have for your family, so you're not leaving them in a bad situation. And those things might need to change whenever you're buying a new home. So I think this has been a great episode. And I think my big takeaway for anybody listening is there's a lot of other factors that come into play. It goes back to why I truly believe when you're making these big decisions, having some sort of person on your team that's helping you think through this. If you don't have a financial partner you're working with, this could be somebody that you trust in your life, but starting to get just a different viewpoint on here's what I'm thinking. What are you thinking? What do the numbers actually look like? What are the things outside of the numbers that we need to be thinking about? And then going from there to make sure that you're in a really good position, because ultimately, whenever you're buying a home, this is something that you want to enjoy and you don't want to be in a position where you're stressed out about it.
And so I think real quick before you wrap up, the one thing I'm going to add really quickly is this is a really great time, even if you're a DIYer, to work with an hourly planner or a one-time planner or something like that. Because I think a lot of times people are like, oh, that's $1,500 or $2,500 or $4,000. Like, oh, I really don't want to go spend that. But if you're buying a $700,000 house today, you're going to probably pay $1.4 million. Paying $2,500 or something like that to ensure you're making the right decision is going to end up being way better for you than going into it and trying to avoid that small cost.
That's a great point. That's a great point. Well, guys, this has been a great series that we've been going through. We really appreciate all the support. And what we always say is Thomas and I are putting in a ton of effort to these podcasts. We want to make sure that you guys are getting value from it. So if there's questions that you guys have, if there's things that you guys are saying, man, I wish that Thomas and Jacob would talk about this, shoot us a DM on Twitter, connect with us on LinkedIn, and let us know. We'd love to answer some of those questions on an upcoming podcast. And make sure you rate, like, and subscribe for future episodes.